Okay, so you want to buy a cigarette company. Buy a factory, print some packs, watch the money come in. But here's the strange part. A cigarette company is the only legal business in the world where your product slowly kills your own customers, where advertising is banned almost everywhere on the planet, where demand has been collapsing for 60 straight years. And it is also, and this is the part nobody believes at first, the single best performing investment in the history of the American stock market. Not one of the best. The best. $1 invested in Philip Morris in 1925, with dividends reinvested, beat every oil company, every bank, every tech stock that ever existed. Anyway, by the end of this video, you'll know exactly how that's possible. How a cigarette company actually makes money when it isn't allowed to advertise. Why losing customers every single year somehow makes the profits go up, and why a cigarette company isn't really the business most people think it is. Part 1. Buying in casinos come in 3 sizes. Cigarette companies come in 3 sizes too, except there's a catch. You can't really build one anymore. You can only buy your way in. Here's the ladder. At the bottom, a small discount brand or a roll-your-own operation. A few $1,000,000 gets you a contract manufacturer, some packaging, and a distribution deal. What it doesn't get you is shelf space, because the giants have already bought every inch of the wall behind the register in every convenience store in America. You'll see why that wall matters in a minute. The middle tier is buying brands the giants don't want. In 2015, Imperial Tobacco paid $7.1 billion for a bundle of cast-offs. Winston, Kool, Salem, brands that Reynolds had to sell just to get a merger approved. $7 billion for the leftovers. And at the top sit the 4 majors: Philip Morris International, Altria, British American Tobacco, Japan Tobacco. Combined value, north of $400 billion. These 4, plus 1 company we'll get to, sell most of the legal cigarettes on Earth. Now, 2 costs nobody warns you about. The first is the license. Except in tobacco, the license is the FDA. Want to launch a single new tobacco product in the United States? You file something called a pre-market tobacco product application. Cost, millions of dollars per product. Timeline, years. Guarantee, none. The FDA has received millions of these applications and authorized only a tiny handful. You're basically buying a lottery ticket, where the prize is permission to spend even more money. The second is geopolitics. The biggest cigarette market on Earth isn't owned by any of those 4 majors. It's China National Tobacco, a state monopoly that sells over 40% of all the cigarettes smoked on this planet. One company, owned by the Chinese government, completely, permanently closed to you. Imagine if 40% of the world's oil belonged to one company and you weren't allowed to buy shares. Why does every government cling to this industry with both hands? Because even the ones that hate it understand the same thing. A cigarette company is just a tax machine with a filter on it. Part 2. Where the money comes from. Now we get to the question that actually matters. Where does the money come from? Here's the number that explains the entire industry. A pack of cigarettes costs roughly 30 to 50 cents to manufacture. Tobacco, paper, filter, box, 50 cents, tops. That pack sells in New York City for $15. But the trick isn't the markup. Lots of products have markups. The trick is what happens when you raise the price. Easiest way to picture it. Imagine you sell coffee and you raise prices 10%. Some customers switch to tea, some brew at home, and your sales drop maybe 10–15%. Normal business. Now imagine you sell cigarettes and you raise prices 10%. Your sales drop about 4%. That's it. 4. Economists have measured this for decades. It's one of the most inelastic products ever studied. And the reason is chemistry. Your customer isn't choosing your product every morning. Nicotine is choosing it for them. That's 6% gap. The price hike customers pay minus the customers you lose. That's the house edge. And here's the part that breaks people's brains. The industry has been running this exact play every single year for half a century. Raise prices 8%, lose 2 or 3% of your smokers, and revenue goes up on a customer base that's been shrinking since the 60s. Cigarette volumes in America have fallen off a cliff since the 1980s. Cigarette revenue barely moved. Fewer smokers, paying more, forever. That's how a dying industry prints money. Now, who's actually paying? Same answer as the casino. It's not the rich. Smoking rates among low-income Americans run roughly double the rates among high earners. The customer with the least money is statistically the most reliable customer in the entire business. A pack-a-day smoker spends $3,000, $4,000, $5,000 a year and keeps spending it in recessions, in layoffs, in divorce. When times get worse, cigarette sales get better. And that pack-a-day smoker is the industry's whale. Do the math on one of them. Pack-a-day, adult lifetime, rising prices the whole way. That's easily $70,000 to over $100,000 in revenue from a single human being. One loyal Marlboro smoker who starts at 18 is worth more lifetime revenue than a car buyer is to Toyota. And unlike the casino whale, this one doesn't need a private jet. He drives himself to the gas station twice a day. Okay, so that's the math. Now, the architecture. Because remember, these companies can't advertise. No TV since 1971, no billboards, no sports sponsorships, no Instagram. So where did the marketing go? Walk into any convenience store and look behind the cashier. That wall of cigarette packs, perfectly lit, at eye level, right where you stand to pay for everything else. The industry calls it the power wall, and it is the last legal billboard in America. Tobacco companies pay retailers billions of dollars a year in incentives for that exact position. It's not decoration. It's the entire ad budget, compressed into 4 square meters, placed at the one point in the store where 100% of customers are guaranteed to stand still. And then there's the loyalty. Smokers switch brands at one of the lowest rates of any consumer product ever measured. The majority stay with one brand for life, which means every marketing dollar isn't spent winning customers. It's spent making sure nobody ever has a reason to look one shelf to the left. The companies also run massive direct mail coupon databases, legally targeting confirmed adult smokers with discounts calibrated to exactly how much each one is worth. The casino had a player's club card. Tobacco built the same machine out of coupons. So here's the whole revenue model in one sentence. Addiction multiplied by pricing power, multiplied by 20 purchases a day, multiplied by decades of loyalty. Every single thing in the business exists to protect one of those 4 numbers. Part 3. So why would anyone lose? So with all this guaranteed chemistry, billions in revenue, customers literally scheduled by their own bloodstream to come back tomorrow, why would a cigarette company ever struggle? The short answer is everything else. Out of that $15 pack in New York, here's who gets paid before you do. The government, first and biggest. Excise taxes run 40 to 80% of the retail price depending on where you are. New York State alone takes $5.35 per pack before the city takes more. In Australia, a pack costs the equivalent of $25–30 and the overwhelming majority of that is tax. On every pack sold, the government is the largest shareholder and it never invested a cent. Then there's a payment most people have never heard of. In 1998, the major US tobacco companies signed the Master Settlement Agreement with 46 states, the largest civil settlement in American history. The bill, over $200 billion in the first 25 years and roughly $9 billion a year, continuing forever. Not a fine you pay off, a mortgage with no house and no end date, indexed to inflation in perpetuity. It's been almost 30 years. They're still paying. They will always be paying. Then the lawyers. Individual lawsuits, class actions, punitive verdicts. Tobacco companies maintain legal departments the size of major law firms, permanently as a standing cost of existing. The casino had liability insurance. Tobacco is liability, with a dividend attached. Then compliance, graphic warning labels, plain packaging laws. In Australia and a dozen other countries, your brand isn't even allowed to look like your brand anymore. Every regulation is another department, another cost, another year of lawyers. And then the leak nobody sees, smuggling. Because when tax is 80% of the price, criminals don't need to make fake cigarettes. They just need to move real ones across a border. Over 10% of the world's cigarettes are illicit. That's hundreds of billions of sticks a year sold with your addiction, your customer, and none of your revenue. The chemistry gives you a guaranteed top line. Everything below it is a fistfight with the government, the courts, and the mafia, simultaneously, forever. Part 4. The two mistakes. And that fistfight is where owners actually lose. Tobacco companies can fail for a lot of reasons, but two mistakes show up over and over. Mistake 1. Too much debt. In 1988, R.J.R. Nabisco, Camel, Winston plus Oreos, weirdly, became the target of the biggest leverage buyout in history. $25 billion, most of it borrowed. There's a famous book about it called Barbarians at the Gate, which tells you how well it went. For the next decade, the company's cash didn't go into brands or products or fighting Philip Morris. It went into interest payments, and while RJR serviced its debt, Marlboro ate its market share and never gave it back. Don't buy an addiction business with debt that assumes the addiction is yours to keep. The addiction is loyal. It's just not necessarily loyal to you. Mistake 2. Wrong product for the market. This one has burned more money in tobacco than anywhere else. In 1988, RJR, same company, same decade, incredibly, launched Premier, a smokeless cigarette that heated tobacco instead of burning it. Development cost, over $300 million. There was just one problem, which is that customers said it tasted like burning plastic, and one executive famously compared the smell to a fart. It lasted a few months, $350 million, killed by a focus group's nose. But that's a rounding error next to the modern version. In 2018, Altria, the owner of Marlboro, the most sophisticated nicotine company on earth, paid $12.8 billion for 35% of Juul, the vaping startup. The bet: Juul was the future of nicotine. Then came the youth vaping backlash, the FDA crackdown, the flavor bans, the lawsuits. Within 4 years, Altria had written the investment down by roughly 95% and eventually walked away with almost nothing. $12.8 billion. One of the fastest, largest destructions of value in consumer goods history, executed by the people who supposedly understood this market better than anyone alive. If you're going to bet $13 billion on the future of nicotine, make sure the FDA agrees with you about what that future is. Part 5. Step back. Step back for a second, because the economics of this industry are genuinely paradoxical. A bakery doesn't know how many croissants it'll sell tomorrow. A cigarette company knows almost exactly, because its customers are chemically scheduled to return 20 times a day, every day, for decades. There is no other legal business with demand this predictable. Not casinos, not utilities, nothing. And yet the whole thing sits on ground that never stops moving. The taxes only go up, the lawsuits never end, the regulations only tighten, and underneath all of it, a slow demographic countdown. Every year, the customer base gets smaller, and the entire model depends on squeezing more out of fewer people, indefinitely. The chemistry is bulletproof. Everything built on top of it isn't. The whole industry is essentially one trade: guaranteed demand against unguaranteed everything else. Survive that trade for 50 years, and the rewards are, well, let's do the numbers. Part 6. The payoff time to pull it all together and answer the actual question. How much do you make if you do this right? Look at Altria, the company that sells Marlboro in the United States. Roughly $20 billion in revenue a year. And here's the number that should be impossible. The operating margin on its cigarette business runs around 60%. 60. The casino business we're comparing against nets 25 to 33% and thinks that's incredible. A cigarette company keeps roughly twice that, while paying the highest taxes of any consumer product in the world, and $9 billion a year in settlement money forever. That's how strong the underlying machine is. And Altria has raised its dividend more than 50 times in the last 50-odd years, through every lawsuit, every ban, every crisis. And here's the fun fact most people miss. the reason a cigarette company isn't the business you think it is. Philip Morris International, the biggest of the majors, now makes over 40% of its revenue from products that aren't cigarettes at all. Heated tobacco, nicotine pouches. If you've seen Zyn everywhere lately, that's them. A modern tobacco giant is barely a cigarette company. It's a nicotine delivery company using cigarettes as the cash machine to fund its own replacement. The product is dying, the molecule is doing fine. Which brings us back to that stat from the beginning, because now you can see why it's true. Finance professor Jeremy Siegel ran the numbers on every original S&P 500 company. The single best performer from 1957 into the 2000s, number 1 out of 500, was Philip Morris. $1,000 in at the start, dividends reinvested, became millions. Why? Because everyone hated the stock. Lawsuits, bans, shame. The price stayed cheap for decades, the dividends stayed enormous, and reinvested dividends compounding into a hated, cheap, unkillable cash machine turned out to be the most powerful wealth formula the stock market has ever produced. So if you do decide to buy a cigarette company, just remember the most important rule of this business. In casinos, the house always wins. In tobacco, the house is whoever holds the shares, and the customers pay the house 20 times a day, whether they win or not. Just make sure you're holding the shares, and not the cigarette.